In this week's update, markets begin 2018 on the front foot, growth expectations boost commodities and inflation-protected funds, and retail is in focus as companies report on Christmas trading. Stock markets ended the first week's trading in 2018 at record levels. Risk appetite continued to increase on the back of a synchronised uptick in economic growth and hopes for the US tax reforms passed just before Christmas. Investor sentiment improved despite an underwhelming set of US employment data on Friday. This suggested that the economy may have lost momentum at the end of 2017, but instead investors were talking of a melt-up in share prices and the first real signs of enthusiasm for the most unloved bull market ever. Such a pickup in investor optimism is typical of the later stages of a bull market, so the newfound euphoria is not being welcomed in all quarters. If it marks the final phase when fear of missing out drives previously sceptical investors into the market, then the end of the cycle will be closer, albeit no one can predict when the turn in the market will actually come. The main driver of renewed investor enthusiasm is tax reform. The proposed cut in the US corporate tax rate from 35% to 21% is expected to deliver another strong year of earnings growth in America, up 13% after a 10% rise last year, according to FactSet's consensus of analyst forecasts. That's made it easier to justify the US market's valuation premium. It's also allowed some market strategists to bring forward their 2019 market estimates to 2018. Other market watchers who are less optimistic warn that 2018 could be a year of two halves, with a kind of what next mood emerging after the initial enthusiasm. One person who's not let inconvenient worries about the sustainability of the bull run get in the way has been President Trump. He's no doubt happy to have a distraction from the media circus around the latest warts and all portrait of life in the White House. Fire and Fury, the book chronicling the first few chaotic months of the Trump administration, has left him in need of a good news story, and he's alighted on the performance of the Dow Jones Industrials Index to provide it. Tweeting that the rise in the Dow from 24,000 to 25,000 was the fastest ever 1,000-point rise, he's guilty of both running fast with the truth, it's happened twice more quickly, and peddling an irrelevance. As the Dow rises, each 1,000-point gain becomes proportionately less impressive than the previous one. By focusing on the Dow, Trump is also being extremely selective. This traditional measure of the US stock market is widely seen as much less meaningful than the broader S&P 500. It holds far fewer companies, and its calculation methodology overweights the performance of some constituent shares in a misleading way. Looking at the S&P 500, the performance of the US stock market in the first year of the Trump presidency is actually worse than in either of President Obama's terms. You would, of course, expect this in light of how cheap the market was when Obama entered the White House and how expensive it was when Trump did. Anyway, quibbling aside, it's now becoming clear that investor psychology has undergone a profound recent shift. First, there's the cryptocurrency mania, which on my chosen measure, the number of times my 17-year-old son mentions Bitcoin, is now very close to bursting. Next, there's the reliable survey of investor sentiment from the American Association of Individual Investors. This shows 60% of investors are bullish against only 16% bearish. Before Christmas, the numbers were 37% and 34% respectively. This is a great contrarian indicator. And it's not just shares that are performing well this year. Commodities have also made a storming start to the year, with the Bloomberg Spot Index at its highest level since 2014. The bullish mood has been fueled by strong manufacturing data as well as a weaker dollar, in which most commodities are priced, and production constraints. Crude oil rose above $68 a barrel for the first time since 2015, and zinc hit a 10-year high. These moves have helped the share prices of commodity producers like BP, the shares of which are at their highest level since 2010. Brent crude has now risen by 50% since June, with OPEC's discipline in curbing output helping to reduce stockpiles and push the price higher. Optimism about future economic growth is also being evidenced by investor interest in hedging portfolios against an unexpected uptick in inflation. Funds that invest in inflation-linked bonds have seen more than $700 million of new money invested in the latest week, according to EPFR Global, which tracks these flows. This was the 11th consecutive week of inflows. The latest minutes from the Federal Reserve showed that the rate-setting committee is increasingly of the view that historically low unemployment will, in due course, push inflation higher. Given a slightly more hawkish composition for the Fed's policy-setting committee after Janet Yellen steps down next month, this could indicate a firming expectation of higher rates this year. On that front, speeches from a number of Fed rate setters this week will shed some light on the latest central bank thinking. Now, on the corporate front, the biggest market-moving announcements this week are certain to come from the retail sector, which traditionally updates investors on Christmas trading in these early days of January. On this side of the Atlantic, we have already heard a mixed bag of reports, with profits warnings from Debenhams and Mothercare offset by better than expected figures from Next. Mothercare in particular has fallen foul of the Black Friday effect. It tried to hold on to full prices in the run-up to Christmas and suffered as others were discounting heavily. Then it sold its excess stock after Christmas, but at wafer-thin margins. Profits in the current year will be between £1 and £5 million. That's less than half the expected £10 million, and that itself was half last year's profits. This week we'll also hear from the UK's supermarkets, with trading updates from Morrisons, Sainsbury's and Tesco. Although these mainstream grocers are expected to have fared reasonably well, a recurring theme looks like being the shift to the German discounters Aldi and Lidl. Aldi has already reported a more than 15% year-on-year rise in total December sales. Non-food sales are unlikely to have done as well, with the threat from online trading more established than in groceries. Marks & Spencer reports third quarter results this week, with a fall of more than 3% expected in like-for-like clothing and home sales over the Christmas quarter. Also in focus this week will be the house builders, with figures from Persimmon, Taylor Wimpey, Barratt and Bovis this week. The UK housing market is expected to slow in 2018, so the sector may look vulnerable after strong price recoveries in 2017. Even while the Christmas trading statements are being absorbed, the first announcements in the fourth quarter US reporting season will start to emerge. As usual, the financial stocks are first out of the blocks, with JP Morgan Chase and Wells Fargo due to announce their quarterly numbers on Friday. And finally, Carillion, the outsourcing group that grew through debt-fueled acquisitions to be one of the government's biggest suppliers, including on the HS2 high-speed rail line, is teetering on the brink of collapse. Saddled with £900 million of debt and a £600 million pension deficit, its market value of less than £100 million is a fraction of the £2 billion it once reached. Talks with bankers and speculation of a government rescue or debt for equity swap may come too late for Carillion's embattled shareholders.